Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is our 84th episode, Handling Volatility. Corey, welcome back to the show.
Thanks, I feel like a regular.
Maybe I should stop saying that because you're back every week.
That's why I thought I'd say
You
I feel
won't
like a
go away.
regular. Persistence.
You're like a dog
Wow.
that keeps coming back to his home.
Persistence.
Thanks
It's
for
helped in
coming
my
back.
career, my relationship.
That's
Yeah.
right.
That's right.
Stay persistent,
That's
Corey.
right. Thanks.
Well, the reason we're having you back on is because the rest of our team is busy working. That's why they're here, right? So they're doing a great job. We've been meeting with a lot of clients, having a lot of conversations, and making sure that everybody's taken care of. Hence, the theme of today's show is handling volatility. It's been crazy out there as of the recording of this market, and I'm assuming that craziness is probably not going to end anytime soon. So I had a really good conversation with a client, and we're recording this still in the first week of March of 2020. And last week, I asked him, I said, do you think the market was up or down last week? And he said, well, down. And I said, you're wrong. It was up. And if you would have asked me the same question,
You'd have thought the same thing.
even though I'm looking at it every single day, I felt like it was down. So the question that we want to answer today, Corey, is how are people to handle volatility? Let's start with our bread and butter client, the retiree. So what is the retiree to think of when the market starts going crazy like this? I mean, we've had days where it's down 8%. Today it was up around 4%. I mean, the thing's going all over the place. So what do you do as a retiree to handle this?
The first thing I would do is try to just kind of bring myself to the moment and think about what approach that I'm trying to follow, and the fact that if you've trusted us as your advisors, that there's a strategy in place for times like this.
Right. And a big thing to remember is that, and people always forget this, is that bonds play a very pivotal role in a portfolio during stock market volatility. And what a bond is it's a loan, and it's designed to be less volatile. Typically, it's a little safer depending on the type of bond that you buy. Mm-hmm. It's designed to just kick out its income and plod along. And that's what our bonds are doing right now. And actually, our bonds for a lot of our clients have appreciated in value.
Right.
So if they do need money for a home renovation or a vacation or whatever, or they're just their monthly spending, we're pulling it from bonds. And what do we do as a general rule on bonds, Corey? How much money do we want to have in bonds for our clients?
Ideally 10 years of I'd say 5 to 10 years, but ideally 10 years of somebody's planned expenses or distributions from their accounts are not invested in stocks, so they're in bonds.
Right. So I remember back in 2007, 2008, when the market crashed, 56%.
I know.
From peak to trough. We bottomed down in March of 2009, and then the thing really turned around and took off. So you're really talking about 3 or 4 years that you need to live off your bonds during that time frame. And to your point, for our clients, when they get into retirement, we like to see them have at a minimum 5, ideally 10, ideally. So again, the idea is we want to be able to weather these storms. So it's literally only been weeks since we've been experiencing this volatility. And our clients that need money, they're just selling their bonds.
Yes.
Right? Pulling from their bonds. And they've got 5 to 10 years worth of money in there, and they're okay.
But there's nothing like a volatile market like this one in stocks to remind us of why we own bonds. Because in a really good year in the stock market, when things are just
like 2019.
Like 2019, things are moving higher. People think, I don't know if anybody's asked this explicitly, but people tend to think like, well, if I didn't have these bonds, my account would be doing a lot better, right? And then you get smacked in the face with volatility and reminded that's why these are here. Because, I joked with the client, I said, everybody defines their investment style as aggressive until the market goes down. Right? Everybody considers himself an aggressive investor, generally, until the market starts to go down. But the bonds really do their job, and they hold their own, and the whole construction of the portfolio and their inclusion in it is designed for years like this one.
Right.
And periods like this one.
And for the retiree, and this actually goes for any investor, we love the fact that during these volatile times, we own individual stocks. If you're in an index fund or you're in a mutual fund, you don't really know what you own. And especially with an index fund, you're just writing it down. You have no downside protection in this type of market if nobody's managing your assets.
Yep.
With our portfolio of stocks, if we need to sell X and buy Y, we can do that. We can make that change. or if we think company Z is very undervalued and we want to go buy more of that, we can do that. So we can be very strategic in our decisions when you're not going to get that in an exchange traded fund. You're literally just writing it down. And a mutual fund, again, not bad, but if your advisor's charging you a fee on top of a mutual fund fee, it can be very expensive and you're going to underperform typically when you're doing that also.
And I just want to, as a quick aside, because we talk about that on the show, because it comes up a lot with investors and with clients. And I had a good conversation with someone yesterday with a prospective client, and we were talking about mutual funds and the expenses associated with them. And he was familiar with the fact that mutual funds, some mutual funds, depending on the share class, which could be its own show, there could be a load when you buy it, or a load when you sell it.
Yeah,
but even if a sales charge, even if you own the fund though, and there's no sales charges, there's still the expense ratio.
Right. Yeah. So you can buy these quote unquote no load funds, which stand for no sales charge, but somebody's getting paid to manage that money, and those are hidden. Typically, those hidden fees that you can only see in a prospectus, and they're typically 1% plus or minus. On top of an advisor fee, it's really hard to make money when your advisor's using.
Yeah, that's a tough hurdle to get over.
Yeah, it's very hard, especially when the market's down.
Right.
So now you're still paying your advisor fee, you're paying a mutual fund fee, and then all the assets are down. And then you don't even know what you own, which is scary in its own right.
Yes.
So I wanted to talk before we switch subjects real quick also about our younger clientele. So as a result, as our practice has matured, we've naturally started working with a lot of our clients' children. What should they be thinking right now about volatility?
They should be thinking this is a tremendous opportunity for me to buy more stocks at lower prices.
Right. So if you haven't funded your Roth IRA yet for 2019, it's not too late to do that. Or if you have some cash built up in your checking or savings account, we're not saying to necessarily back up the truck, but if you are confident, like we are, that stock prices expect to be higher 5, 10, 20 years from now, why wouldn't you take this as a buying opportunity and buy some shares? I was just joking with a client right before this show. That comment that you made is that investors are the only people that don't like to buy things when they're on sale.
Yep.
Right? So stocks are on sale right now. Maybe they're down 15% off. I don't know. When you're looking for a suit, if it's a nice suit from a name brand, if it's 15% off, do you not want to buy it?
No, I do. Especially if I'm suit shopping anyway, right?
Right.
I could sit around and wait to see if maybe it goes down 25%. Maybe it goes down to 25% off instead of 15, or it could bounce back to the normal price and I miss the opportunity.
Right. So you'd rather buy things on sale. Stocks are on sale. If you're an investor and you have some cash, we see this as a potential buying opportunity.
Or also, I talked to somebody recently that had been considering starting to save more money in their 401k at work because they found that their savings was building up.
Right.
It's like, well, it's a good as time as any to probably consider bumping up your contributions if you have the means to do so.
Yes.
Because you're buying more. This is a great time to be doing it.
Right. And in no way is this us trying to predict the bottom. Right. It could get a lot worse than this.
Yes, absolutely.
What we're saying though is you don't want to sell stocks when they're low. You want to buy them. And you don't want to sell bonds when they're low. You want to sell them when they're high. Bonds are high right now. Stocks are low. Right. So if you have cash, you want to buy stocks. If you need cash, you want to sell bonds. And that's why as part of a properly diversified portfolio, especially for the retiree, those are big major components in both. And in fact, when we used to do the Bird of Prey lightning round, I would ask as one of my questions, do you like stocks or bonds? And almost everybody would say stocks.
Last year the answer was stocks. Right?
Yeah.
This year,
but James, to his credit, James is a certified financial planner on our team. He said both.
Smart.
Very smart, right? I said stocks or bonds, James. He said both, Jake. And that's a good answer, right? And this is why both make sense, especially for the retiree. Now, if you're younger, you're in your 20s and 30s, and you're not going to need your money for 10 or 20 or 30 years, it's okay to be a little stock heavy. What we're saying is maybe now's the time to buy.
Yes. And I also, and just your point about selling bonds makes sense because I had one other conversation today where if you just look at a chart and you look at bond prices, right? So bond prices and yields move inverse of each other. If you look at bond prices, particularly just over the last few months, they've basically gone parabolic where they've just gone straight up. The same way that if you go and look at a chart of...
You're talking fast. Did you drink coffee right before this?
Mm-mm. I think I'm just excited to talk about bond prices. But anyway...
Stocks have gone down the same way as bonds have gone up, is what you're saying?
And if you look at other investments that have been sort of all the rage the last few years, those charts look similar, where they went straight up and they peak and they start to go back in the other direction. Your point about if there's ever going to be a good time, if the numbers in their portfolio dictate doing so, what a great time to sell bonds and buy stocks when they're cheaper.
Right. So we are doing that if the math dictates it. Again, you're not going to rely on my gut feel or Corey's or anybody else's on our team. If the numbers tell us to sell bonds and buy stocks, we're going to do it because that's what the math says. Good.
All right.
Do you want some more coffee?
No, I don't think so.
All right, so we're going to do the Falcon Bird of Prey poll, Facebook poll right now. We haven't done one of those. I think I skipped an episode. So I got one here for you, Corey. So the question we asked out there on our Facebook page, and a quick plug here, commercial for our social media. If you're not already following us out there, we are out there on Facebook, we're on Twitter, we're on LinkedIn, we're even on Instagram. Why a couple finance guys are on Instagram, I don't know, but you and I are on there. Also, you're watching this on YouTube. Thank you so much. Please hit a thumbs up button or share our content. Also, if you're listening to this on your favorite podcast platform, we really appreciate it. We've been getting a lot of good feedback. And if you have any show topics, feel free to send me an email. You can email me directly at jake@falconwealthadvisors.com. And Corey, what about your email?
Corey@falconwealthadvisors.com.
Okay, enough for our commercial here. So again, we did a poll out there. We're calling it the Falcon Wealth Advisors Bird of Prey Facebook poll.
All right.
And what we did is we asked our followers, do you know what to do about healthcare in retirement? So how many people do you think said yes on this one, Corey? We had 27 votes. How many do you think said yes? Percentage.
60.
60%? Oh, did you look at this?
I didn't actually.
59% said yes.
Look at that.
This is a very popular subject that we talk about. So that tells us that 41% of people out there, according to our poll, which is very unscientific,
Yeah.
don't know what to do about healthcare. Now, there are some things you can do. Obviously, if you're 65, you want to transfer into Medicare.
Sure.
If you're under 65 and you retire, your company more than likely will offer COBRA benefits, which are normally last 18 months. But if you're 50 and you only have 18 months, you got to figure something out to do the other 13 and a half years. So that's when we engage with an independent health insurance broker. We work with a great one here in town that she can shop the open market and help you make a good decision. Also, your company may offer it as well. So there's all these different options you need to weigh. The most important thing to remember, though, is you want to have that number, whatever it is, figured out before you retire, and you want to have it built into your financial plan's budget.
Yes.
Because if you don't, it could be a very big surprise. It could throw things off kilter. So that's something that we take, very prideful at Falcon Wealth Advisors. We're going to have that conversation with you before you retire. Now, if you're 3, 5, 10 years out from retiring, it might be too early to be looking at that because the landscape changes, right? The rules change. So we would say what? 1, 2, 3 years out? We can always put a number in there as a placeholder, but to seriously look at healthcare, because the law changes so much and the prices change, what do you normally, you probably start looking at it seriously, a year out?
Probably so.
Yeah.
Because again, all we can do is use what the numbers and assumptions are today. Sure, you can
Right.
inflate it, but
Right, and we'll plug a
Things
number
change.
in based on today's rates. If you
Yes.
want to budget for it and allocate it, absolutely. That's smart to do. But to get serious about it, I'd probably
Yeah,
look
yes.
a year or two out from retirement and start meeting with a health insurance broker or somebody that can help give you some sort of guidance along that.
yes, great idea.
Perfect. Well, that's all the time that we have for tonight's show. Thank you again for tuning in, and we hope you all have a great week.